We begin with Zillow Group's first quarter 2026 results. Total revenue reached $708 million, an 18% year-over-year increase and at the high end of our outlook range, demonstrating Zillow Group's continued strong growth. Across the broader housing market, purchase mortgage origination volume for the industry declined approximately 1% year-over-year in Q1, according to the National Association of Realtors. Zillow Group's for-sale revenue grew 12% year-over-year to $514 million in Q1. Notably, residential revenue saw an 8% year-over-year increase to $450 million, benefiting from growth across Preferred, Zillow Showcase, our suite of agent software tools, and our new construction marketplace. The $64 million in Q1 purchase loan origination volume, representing a significant 96% increase to $1.5 billion, also contributed to the for-sale segment's growth. Furthermore, rentals revenue surged 42% year-over-year to $183 million in Q1, primarily driven by a 57% growth in multifamily revenue. In the first point, net income stood at $46 million in Q1, with a net income margin of 6%. This represents a 520 basis point increase year-over-year, and diluted net income per share was 19 cents, a significant improvement from 3 cents in Q1 of the previous year. The second item shows adjusted EBITDA at $182 million, with a margin of 26%. This is flat year-over-year, achieved despite a 160 basis point headwind from incremental legal expenses. Excluding these $11 million in incremental legal expenses, adjusted EBITDA would have been $193 million, representing a 27% margin. Thirdly, cash and investments were $788 million at the end of Q1, down from $1.3 billion at the end of 2025. However, during Q1, 13.5 million shares were repurchased for $626 million. Finally, traffic to Zillow Group's mobile apps and sites decreased by 3% year-over-year in Q1, reaching 220 million average monthly unique users. Visits during the same period were down 3% to 2.3 billion. According to Comscore, which tracks growth trends across the category, this contrasts with the average monthly unique visitors to Zillow Group's mobile apps and sites increasing by 12% year-over-year to 127 million. Making Zillow the only company in our category to increase the amount of the real estate audience we reach over the past 6 quarters. This slide presents the first quarter 2026 results for the for-sale segment. For-sale revenue grew 12% year-over-year, reaching $514 million in Q1. On a trailing 12-month basis, for-sale revenue per TTV at the end of Q1 was 8.7 basis points, an increase from 8.0 basis points in the same period of 2025. The bar chart on the right visually illustrates the quarterly trend of for-sale revenue from Q4 2025 to Q1 2026, showing a positive growth trajectory from $458 million, $482 million, $488 million, and $475 million, culminating in $514 million. The chart you are currently viewing illustrates the revenue trend for the residential segment. In Q1 2025, revenue reached $450 million, marking an 8% increase year-over-year and demonstrating a positive growth trajectory. A significant portion of this growth is attributed to the expansion of Zillow Preferred, the growth in connections within our enhanced markets, and strong conversion rates through our preferred partners. Furthermore, Zillow Showcase's agent software tools and the new construction segment also contributed to residential revenue growth. However, it is important to note that revenue from the market-based pricing segment continues to decline as we transition the majority of our agent-related activities to our preferred partners. The key takeaway from this chart is the remarkable growth in the mortgage segment. Mortgage revenue for the first quarter increased by 56% year-over-year, reaching $64 million. The primary driver behind this surge is a 96% growth in purchase loan origination volume, which amounted to $1.5 billion. Furthermore, our mortgage strategy is successfully channeling more buyers towards financing through Zillow Home Loans, making it the main growth driver for our overall mortgage revenue. Preferred partnerships are also contributing to this positive trend. Let's first examine the rentals section. Rentals revenue increased by 42% year-over-year, reaching $183 million. This growth was primarily driven by a 57% surge in multifamily revenue. Furthermore, Zillow Rentals averaged 36 million unique monthly visitors in Q1, demonstrating continued expansion. Notably, the number of multifamily properties advertising on Zillow reached 76,000 by the end of Q1, an increase of 21,000 properties, or 38%, from the end of Q1 2025. This indicates a strengthening position for Zillow within the rental market. This slide presents the net income and adjusted EBITDA metrics. Net income for the quarter was $46 million, with a net income margin of 6%, representing a significant 520 basis point increase year-over-year. Diluted earnings per share stood at 19 cents, a substantial improvement compared to 3 cents in the same quarter last year. Adjusted EBITDA reached $182 million, and the adjusted EBITDA margin was 26%, remaining flat year-over-year. This performance was achieved despite a 160 basis point headwind from incremental legal expenses. If we were to exclude the $11 million in incremental legal expenses, adjusted EBITDA for the quarter would have been $193 million, yielding a 27% margin. Total operating expenses and cost of revenue reached $672 million in Q1, marking a 1% increase from the previous quarter and an 11% rise year-over-year. The year-over-year increase was primarily influenced by a $50 million rise in the cost of revenue, associated with higher lead acquisition costs, which fell within our expectations as part of the rentals syndication agreement with Redfin, and increased mortgage loan processing costs due to higher purchase loan origination volume. The $12 million increase in sales and marketing expenses was primarily driven by headcount-related expenses supporting increased purchase loan origination volume. General and administrative expenses saw a $2 million increase due to an $11 million rise in legal expenses, partially offset by a $9 million decrease in headcount-related expenses, mainly driven by a reduction in share-based compensation expense. Adjusted EBITDA expenses were $526 million in Q1, up 18% year-over-year, and below our Q1 outlook of $535 million to $540 million. This table presents a reconciliation of adjusted EBITDA expenses to total operating expenses and cost of revenue. Let's first look at the cost of revenue, which was $189 million in Q1 2026, an increase of 6% from $178 million in Q4 2025, and a year-over-year increase of 36%. Sales and marketing expenses stood at $210 million in Q1 2026, up 2% from the previous quarter and up 6% year-over-year. Technology and development costs were $150 million in Q1 2026, a 3% decrease from the previous quarter but a 1% increase year-over-year. General and administrative expenses amounted to $123 million in Q1 2026, down 4% from the previous quarter and up 2% year-over-year. Cumulatively, total operating expenses and cost of revenue reached $672 million in Q1 2026, a 1% increase from the previous quarter and an 11% increase year-over-year. Moving on to the subtractions, less share-based compensation was $81 million in Q1 2026, a 15% decrease from the previous quarter and a 16% decrease year-over-year. Depreciation and amortization remained unchanged at $65 million in Q1 2026, showing 0% change both quarter-over-quarter and year-over-year. Finally, adjusted EBITDA expenses concluded at $526 million in Q1 2026, marking a 4% increase from the previous quarter and an 18% increase compared to the same period last year. This slide summarizes the company's balance sheet and cash flow. In Q1 2026, net cash provided by operating activities reached $200 million, marking a substantial 92% increase compared to the same period last year. Furthermore, adjusted free cash flow for Q1 2026 was $127 million, up 44% year-over-year. This strong performance indicates a significant improvement in the company's ability to generate cash from its operations. As of the end of Q1 2026, cash and investments stood at $788 million, a decrease from $1.3 billion at the end of 2025. Primarily due to the repurchase of 13.5 million shares for $626 million during the quarter. Approximately $1.3 billion remains available under our share repurchase authorizations. With a $500 million undrawn revolving credit facility, the company holds total liquidity of $1.3 billion. This provides continued flexibility to pursue key financial priorities, including investing in growth, maintaining an adequate risk-based capital reserve, pursuing potential M&A opportunities, and remaining opportunistic with share buybacks. The company's robust financial position offers a strong foundation for its future strategic initiatives. Let's review Zillow Group's outlook for the second quarter of 2026. Total revenue is projected to be between $750 million and $765 million, indicating a similar level of growth compared to the same period last year. Specifically, residential revenue is expected to see mid-single-digit growth, while mortgage revenue is anticipated to remain at similar levels to Q1. The rentals segment revenue is forecasted to achieve approximately 30% growth. Adjusted EBITDA is expected to fall between $150 million and $165 million. Excluding approximately $20 million in incremental year-over-year legal costs anticipated in Q2, this would amount to $170 million to $185 million. Furthermore, advertising spend is projected at around $80 million, an increase of $16 million year-over-year from last year, with this rise attributed to the timing of new product launches already included in the original annual outlook. These figures offer significant insights into the growth drivers and profitability of Zillow's business segments. This slide outlines the outlook for 2026. Based on our Q1 results and Q2 outlook, we are on track to achieve our full-year goals. For the full year 2026, we anticipate a mid-teens year-over-year growth in total revenue. Specifically, we expect rental revenue to grow by approximately 30% year-over-year. Our fixed cost base stands at roughly $1.1 billion and is projected to grow in line with inflation. The variable cost base is expected to outpace revenue growth in the first half of 2026, trending towards aligning with revenue growth by the end of the year. Advertising spend will see modest growth to accelerate consumer awareness of our expanding offerings. Finally, we project year-over-year expansion in our adjusted EBITDA margin. This indicates that our structural revenue growth drivers and cost levers are well intact, and we expect these structural drivers to result in improved adjusted EBITDA. The company's full-year outlook indicates that both revenue and net income are growing faster, and this trend is also reflected in adjusted EBITDA. Specifically, margins are expected to expand meaningfully in the second half of 2026, driven by four key factors. First, we will continue to leverage fixed costs, which are within our control. Second, variable expense growth is projected to decelerate. While we anticipate a headwind of over 400 basis points to adjusted EBITDA margins in the first half of 2026, this headwind is expected to largely offset by year-end, resulting in a positive swing for the bottom line. Third, legal expenses are expected to pose an approximate 200 basis point headwind to adjusted EBITDA margins in the first half of 2026. However, as the FTC trial progresses, this headwind is anticipated to lessen in the second half of the year. Lastly, advertising spend is weighted more heavily in Q2 this year compared to prior years, due to planned product launches. In the latter half of the year, advertising is expected to follow a more typical seasonal pattern, meaning less year-over-year pressure on margins than what we experienced in Q2. This table presents a reconciliation from net income to adjusted EBITDA. For the most recent quarter, March 31, 2026, net income was $46 million, a significant decrease from $3 million in the prior quarter, December 31, 2025. This fluctuation is primarily driven by changes in other income, net, and the impact of non-cash expenses such as depreciation and amortization, and share-based compensation. Specifically, for the March 31, 2026 quarter, depreciation and amortization amounted to $65 million, and share-based compensation was $81 million. By adding these items back to net income, and adjusting for income taxes and interest expense, the adjusted EBITDA for the March 31, 2026 quarter reached $182 million. This represents an increase from the $149 million reported in the previous quarter. Looking at the calculation of adjusted EBITDA expenses section below, revenue for the March 31, 2026 quarter was $708 million, from which $526 million in adjusted EBITDA expenses were deducted, allowing us to see the proportion of adjusted EBITDA expenses relative to revenue. This data provides a clearer understanding of the company's operating performance and profitability. Let's first examine the reconciliation of adjusted free cash flow. Net cash provided by operating activities for 2026 stands at $200 million, a significant increase from $104 million in 2025. This improvement is attributed to reduced purchases of property and equipment, lower acquisition of intangible assets, and decreased net borrowings. Notably, the initial payment in connection with the Redfin Rentals partnership, present in 2025 with $100 million, was absent in 2026. Consequently, the adjusted free cash flow for 2026 is calculated at $127 million, showing an improvement from $88 million in 2025. Moving on to the revenue section, for sale revenue in 2026 reached $450 million, an 8% increase compared to $417 million in 2025. Mortgage-related revenue also saw a substantial rise of 56%, from $41 million in 2025 to $64 million in 2026. As a result, total for sale revenue grew by 12% year-over-year, from $458 million in 2025 to $514 million in 2026. Rental revenue increased by 42% from $129 million in 2025 to $183 million in 2026, while other revenue remained flat at $11 million for both years. Total revenue demonstrated robust growth, rising 18% from $598 million in 2025 to $708 million in 2026. These figures suggest a strengthening financial performance for the company. This table illustrates the changes in key profitability metrics as a percentage of revenue. First, looking at the gross profit margin, it decreased by 4.6 percentage points from 76.8% in 2025 to 73.3% in 2026. This suggests a slight decline in the ability to generate profit relative to sales, likely due to rising costs. Next, the net income margin dramatically surged by 400%, increasing by 520 basis points from 1.3% in 2025 to 6.5% in 2026. This strongly indicates effective cost control in addition to revenue growth. Finally, the adjusted EBITDA margin slightly increased by 0.4 percentage points from 25.6% in 2025 to 25.7% in 2026, resulting in a 10 basis point change. This signifies a modest improvement in the company's ability to generate cash from its core operations. Overall, while the gross profit margin declined, the substantial increases in net income and adjusted EBITDA are very positive signs, demonstrating improved efficiency and enhanced profitability for the company.